PDD just brought in $17.7 billion this quarter, but their profits actually tumbled over 16% because, well, the e-commerce giant is essentially paying the shipping fees for remote Chinese villages. Welcome to Earnings Unscripted. It is March 25th, 2026, and we are unpacking the Q4 2025 results for PDD Holdings, ticker PDD. And just before Miro tears into the balance sheet, a quick reminder that nothing we say here is financial advice, just two friends throwing personal opinions at the wall. So Miro, the top line is obviously still growing, but they're deliberately crushing their own net income. What is your first read?
It is definitely a calculated sacrifice. Look, when you see a company grow total revenue by 14.4% in a single quarter, you usually expect the bottom line to catch that tailwind. But they posted this massive drop in diluted EPS down to $2.36, and management is basically waving a white flag on short-term profitability.
Right. They explicitly warned that these depressed margins are the new normal, which honestly kind of explains the wild stock action today. It dipped down in the pre-market, then surged right at the open, and finally just faded to close with a really modest gain around $102.
Yeah, the tape is just reflecting pure confusion. Investors look at the $60.4 billion in cash they have sitting around, literally $60 billion, and they see transaction services up 16%. The core engine is still absolutely screaming. So the market is trying to price in a company that is growing rapidly, but, refusing to actually harvest the profit from that growth.
Because they are spending it all on rural logistics, which is kind of amazing from a human perspective. I mean, they literally have these do local specialties teams visiting farmers, teaching them how to process things like pour coffee or Annuay lemons. And then PDD just eats the last mile transit cost to get it out of the villages.
Sure, it is a great story, but from a structural standpoint, they are buying a moat that competitors simply cannot afford to match. The problem is, it costs an absolute fortune. Operating cash flow got slashed by almost half quarter over quarter, down from 45.6 billion RMB to just 24.1.
Wow. Okay. That is a heavy price tag for a moat. And we haven't even touched the whole geopolitical puzzle yet.
Exactly. They are fighting a very expensive, very complicated multi-front war right now.
All right. Let us get into the details on where exactly this cash is bleeding out.
Yeah, so about that missing cash flow, you drop from roughly 45 billion to 24 billion operating cash in one quarter. That is not just paying for rural delivery vans. Look, they are taking an absolute blowtorch to their short-term margins. A massive chunk of this capital is going directly into what they call the New Quality Supply Initiative.
Which honestly sounds like a completely generic corporate slogan. I mean, every platform says they want better supply.
Right, but they are backing it up with actual cash at the factory level. It is basically blurring the line between an e-commerce marketplace and a private equity firm.
Wait, private equity? How does an app act like private equity?
Well, they are literally going out into these Chinese industrial belts, places manufacturing, Henan spicy snacks or Shanghai chocolate, and they are executing these really deep fee reductions for the factories, but it comes with a strict catch. The merchants have to take those specific savings and intentionally shift that capital to hire internal R&D engineers. They are funding upgrades to physical production lines.
So they're essentially paying third-party factories to invent better snacks? That's actually wild.
It's a massive structural shift because Jia Zhenjiao basically spelled it out on the call. He said, and I'm quoting exactly here, "The future performance of e-commerce platforms will increasingly be dependent on how much incremental value they can create for the entire supply chain rather than relying solely on traffic acquisition."
Okay, let me pause right there because that is a huge philosophical pivot. Traffic acquisition was literally the entire playbook for the last decade of tech. You buy ads, you trap eyeballs, you win.
Yes, but traffic is just a commodity now. If you own the factory's R&D capability, you own a differentiated premium product. Nobody else can sell it at that margin. So they are trading immediate cash flow for long-term ecosystem lock-in. But, and this is the really uncomfortable part of the filing, the operational scale of doing this globally is cracking them internally.
Right. The corporate governance shuffle. Yeah, I read that part in the transcript, and it honestly shocked me. You almost never hear management be that blunt about their own flaws.
No, you do not. Jiajin Zhao openly admitted they established a co-chair structure late last year because, quote, their governance and internal talent development have lagged behind the business growth. He literally said it is difficult to keep up in many areas. They are running a thermal budget at Redline, basically.
Which translates to, we grew too fast and our internal scaffolding is starting to buckle.
Exactly. You couple that structural immaturity with the geopolitical headache they are facing globally. Lei Chen brought up their international markets, and it is a mess.
You mean the quote about the contradictory regulations?
Yeah. They operate in nearly 100 markets now, and he explicitly warned that different regions' compliance, data, and tax rules are mutually exclusive. Like, they literally cannot please all their host countries at the same time. You comply perfectly with country A, and by doing so, you are violating a new policy in country B.
Jeez, that just has to be exhausting. I mean, you build a business that normally takes 10 years to mature, you compress that growth into 3 years, and suddenly you are fighting complex trade wars on 100 different fronts.
And doing it with a management team that just told investors they are understaffed for this level of complexity. So when you ask where that missing cash is going, it's not just supply chain investments, it's friction. They are paying a massive geopolitical tax and an operational tax all at once.
It really makes you realize how fragile hypergrowth can feel, even when you have $60 billion in the bank. You know, you can buy a lot of factory upgrades, but you absolutely cannot buy international diplomatic immunity. So, looking at all this weight on their shoulders, where does this leave them heading into next quarter?
Well, actually, it leaves them completely abandoning any traditional financial guidance. They explicitly opted not to give a specific revenue or EPS target for the coming quarters.
Wait, really? They just left it a blank space?
Pretty much. Lei Chen came right out and warned that the global environment is going to weigh on performance. He basically telegraphed that these intense margin fluctuations we just saw, that is the new normal. They are keeping their foot on the gas for these strategic investments.
Right. So if you are an investor, you kind of just have to trust the process, which is a huge leap of faith when they literally just admitted their own internal structure is struggling to keep up.
Exactly. But to give credit where it is due, they are fully aware of it. Jiajin Zhao actually made this really fascinating comment on the call. He said, let me find it. Right. He said, in the next 3 years, we will have the opportunity to build another Pinduoduo.
Wow. That is a massive flex.
It is a massive flex. They are telling Wall Street, look, the era of easy traffic is over. We are building the hard physical infrastructure now. It is going to be volatile. It is going to be highly unpredictable from quarter to quarter, but we have the $60 billion in cash to survive it.
It's like they're tearing down the house while they're still living in it just to pour a deeper foundation.
Yeah, a very expensive, very highly regulated foundation.
Fair point. So I guess next quarter we just strap in and watch the cash flow statement. If that rural trend shipping strategy actually starts pulling in new demographics, maybe the market forgives the spending spree.
Probably. But if that geopolitical pressure tightens up faster than the margins recover, we're going to see a lot of very nervous shareholders.
Which usually makes for a very entertaining earnings call for us to dissect. All right, I think that wraps up our look at PDD for today. Catch you guys next time.
If you want these earnings drops to just show up in your feed, it is probably easiest to just follow the podcast. We actually use AI to help comb through the absolute mountain of SEC filings, which saves us from reading thousands of pages by hand, but the actual takeaways are all ours. We love hearing what you want us to dig into next, so shoot an email over to earningsunscripted@datamadness.ca or just grab the X link in the show notes.
Thanks for listening.